Seth Carpenter, your note is frightening. The brewing storm you talk about, it sounds like winds of war from 1939 and all. Define the brewing storm. What is the distinction now of this August of 2022?
Yeah, I mean, I think for markets, August is always a low liquidity moment, so you're going to see all sorts of choppiness there. But I think when it comes to the macro front, you've got three key economies in the world. You've got the U.S., you've got Europe, you've got China. China, we know, is struggling. They had a contraction in Q2. They've got this burgeoning housing problem that they're trying to solve. The PBOC just had to ease policy again in a bit of a surprise move. Now, we think Beijing, through various sorts of policy, both monetary and fiscal, will come to the rescue. But the question is, when does the inflection point happen? And do we get a big rebound, or is it soft? Shifting to Europe, right? You've got this restriction in gas flow from Russia's invasion of Ukraine. That's crippling the European economy. We have a baseline view of a recession in Europe, Q4 being outright contraction, Q1 being another contraction. So that's not a great look. So the US, right now, pretty solid. We got the retail sales report in line with our expectations. The consensus a little bit. Non-farm payrolls was super strong at over 500,000. But is good news in this case? I don't know. The Fed has been very clear. They need to slow the economy down. So the stronger it is now, the more hiking they have.
You know, we always look at our guests and we try to figure out from the back of their bookshelf, Seth Carpenter, what they're actually thinking. And it's good to see that you've got Tony Crescenzi of PIMCO's Steigum's Fixed Income Bible over your right shoulder. What does the bond market tell an economist like you?
I mean, I think right now the bond market is really struggling to read the tea leaves about what's happening. We saw this sense of relief in markets, I think, when we got CPI tipping over and when the market heard the Fed saying, gosh, we're taking a balanced approach. We care about both the growth in the economy and inflation. But what I think the market didn't hear enough of is the way inflation over the next 2 years is going to come down to the Fed's target is only if you get enough slowing in growth. And so as a result, you know, we think the peak rate that the market has priced is about right, but the cuts in that the market has in place for a lot of next year, that's not really consistent with our forecast.
Well, on that point, Seth, the market thinks that the Fed is going to get to the terminal rate and then very quickly thereafter come down from it. We've been having the conversation all week as to whether or not that's really true. How long do you think they have to stay up there?
I mean, our baseline forecast is that they're there for a year. So they get to the peak rate in December, and then the first very grudging, 25 basis point easing off in terms of a cut comes a year later in December of 2023. I mean, the short answer is no one knows for sure. We think the U.S. economy has a fair amount of momentum behind it. And more importantly, as I was saying before, they really do need to slow things down a lot. They need to take job growth from 500,000 per month down to something closer to 100,000 per month, or maybe even a little bit below, in order to get that real underlying trend inflation down. So they're going to have to stay tight for a while.
How low do you think realistically inflation will get? Is 3% going to be the new 2%?
So sadly, this is where you get the egg-headed economists talking about the two different measures of inflation, CPI versus PCE. I think 3% on CPI is very, very possible. I don't think the Fed's going to be happy to just let PCE inflation, which is really what they set that 2% target for. I don't think they're going to be happy to let PCE inflation settle in at 3%. They'll be happy when it gets down to 3% if it's on a downward trend. But they're not going to declare victory if it's hanging out at 3% and not budging.
Well, Seth, frame your and Ellen Zentner's x-axis. To me, the big mistake here is the now of how policy is going to move. Is this really a 6-quarter, 8-quarter, even 12-quarter path that we're on far longer?
Tom, that's a great way of phrasing it. I think one issue that's important for everyone to keep in mind is that monetary policy does in fact work with a lag. We know that markets are pricing in now a peak rate that's close to where we think the peak rate is, just over 3.6%. But in terms of the actual drag on the economy from that policy stance, it hasn't shown through completely yet. We've seen it in housing. That's important. We're going to see it a bit in durable goods, and we'll see it more in durable goods, but that still has to play out. So it is not what's going on right now that matters. It is, in fact, as you say, what happens over the next 2 quarters, over the next 4 quarters, and yes, ultimately over the next 6.
How will corporations and their investment react to a pernicious 4 or 5% inflation? In the United Kingdom, everyone from Liz Truss to Mr. Sunak suggest there's been a dearth of investment in the UK. Are we going to see a dearth of investment in the United States?
So I don't think we're going to see a dearth of investment, but we should, by all expectations, see a slowing in that investment spending. What you see in the macro data is typically business investment spending tends to follow the overall trajectory of the economy. And so if we're right that the slowing in housing, the slowing in durable goods spending, and with it, the slowing in jobs leads to an overall slowing in aggregate demand, then absolutely businesses should be looking around and saying, okay, there's going to be less of a need for that sort of aggressive investment spending. I don't think it drops off of a cliff. I don't think we're going to have a massive shortfall. The UK has its own idiosyncratic issues, let's say. But we should see things starting to slow down as aggregate demand slows down and businesses pay attention to that.
Seth, we all know I read a lot of Morgan Stanley research. I share a lot of it on this program.
I'm wondering,
Seth, of course, you'd say that. Seth, I'm wondering when I received that note from you that says global recession, that's the base case. How close are we to you sending that note?
Gosh, the SEC would get mad at me if I previewed forthcoming research. So I will say this, we definitely had a global recession as one of the scenarios when we put out our mid-year outlook in April, and we are very much moving closer and closer to that scenario. I mean, the gas situation in Europe matters a lot, and we have a recession in Europe as our forecast. There's clear downside risk to China from their housing situation, something that's gotten worse since we wrote that note. So we're moving in that direction. I think it's too soon yet, though, to call it a recession.